Now, we've all heard the terms remortgaging or refinancing, but what do these actually mean? YouTube, welcome back to another video. And in today's video, we're going to be looking at what is refinancing, what is the process for actually going through and refinancing, how can we apply this to the buy, refurbish, refinance model, and what is pre and post 6-month refinancing look like when we're doing the BRR model. So first of all, what are my credentials in order to be able to give you this information? Well, I purchased my first home back in 2015. And 2 years later, I had to remortgage that onto a new product, a new lender, and a new overall mortgage term. I also have 2 buy-to-lets, one of which I've just gone through the buy, refurbish, refinance process. And I've just refinanced that house. And last of all, the other buy-to-let, which I'm just about to start the refinance process on. So I'm fairly well versed in this. I feel like I have enough knowledge where I can come to you today and give you enough value about the refinancing process. Because although not as scary as perhaps the word sounds, it is still a longer process than it's made out to be online and by some of the more typical gurus. So first of all, what is refinancing or remortgaging? Well, if we had purchased a property, regardless of whether it's cash or mortgage, at some point you might look to remortgage onto a new product. Now, if you had purchased a property with a mortgage, now you'd usually have a mortgage term of say 25 or 30 years, but the actual product itself might last for 2 years, 5 years, maybe even 10 years. That could be a fixed or variable rate product. But when you get to the end of, for example, the 2 years, you would then look to remortgage onto a new product so that you don't pay the higher interest rates. So the actual term refinancing, remortgaging is where we might switch to a new lender, we might remortgage at a higher price, and we pay back the original debt to the previous lender and maybe pull out some equity if we wanted to during the process. If not, then at least you have a higher loan to value debt ratio. You've got more equity left in the property. So now let's quickly cover what does the refinancing process look like? Perhaps a topic that isn't actually discussed very much online. So first of all, speak to your mortgage advisor, get his or her knowledge on what the best mortgage products are out there for you. And next up, you're gonna then choose your remortgage price. Funny, eh? You know, I always thought when you go to a bank, they are the ones that tell you what they think the house is worth. But when it comes to remortgaging, you actually have to choose the price for yourself. Now, of course, if you choose a price that's too high, the bank are gonna come back and say, look, sorry, Justin, that's far too expensive. We're not willing to loan you 85,000 when we think the house is actually worth 75,000. So obviously if you go too high, they're gonna recorrect you. Or if you go too low, then they're just gonna say, great, we believe it's worth that too. Here's your remortgage funds. So you've got to get it right. You've got to try and put in the correct price. And the best way to do that is by, of course, looking at what's sold within a 1/4 mile radius of the property that you are refinancing. So once you've spoke to the broker, you've chose your price, you're now going to also look at how much equity do you want to leave in this property. Perhaps you've owned this 2 years and it's gone up in value. Are you going to pull out that equity, or are you going to leave it in and actually have a better loan to value ratio? What that means is you'll have more equity left in the property, which means hopefully you will have less debt when it comes to the mortgage and hopefully a better rate, because maybe instead of having 25% in that property, you now have 40% in that property and you're only taking out a 60% loan to value mortgage. But regardless, once you have decided how much equity you're going to leave in or perhaps take out, then you can decide exactly what product you're going to remortgage onto. So if you're going to do another 2-year fixed and you perhaps look at leaving 25% in with a 75% mortgage, then your broker can go off and get the best rates for you, compare the market and all the different lenders. So once you have chosen your product, you can then progress this through to the mortgage application. Now, of course, there's lots of paperwork at this point. You'll have to provide wage slips, bank statements, maybe even ID, but then your case is then progressed to the next stage. And the next stage is handing that over to conveyancers. So much like when you purchased the property and your solicitor reported to your lender, your new lender is also going to want to go through some of the same information. So looking at the property title, going through the searches and just making sure they've done all of their DD, their due diligence. Once they're happy, then you can actually go through to the next stage where you release the money. But approximately that's going to take you 4 to 6 weeks. Sometimes it's done quicker, sometimes longer, but inevitably it's always a bit longer than people would lead you to believe. And there's also a cost attached to this. So depending on the size of the mortgage will depend whether you have to pay for the conveyancing. But of course, what I found when it comes to like buy-to-let and investing is certainly anything under £100,000 is going to have a fee attached to it of maybe anywhere between £300 and £600 to pay these conveyancers to do this remortgage for you. Now that's the process on what it takes to do a remortgage, so I hope that clears up some of those steps for you. Now we're going to look at what is pre and post 6-month refinancing, what does that even mean, and we're going to apply this to buy, refurbish, refinance. Moving on to the buy, refurbish, refinance model. Now, when I talk about pre and post 6 months refinancing, it very much is in relation to this BRR process, and that is because you buy a property, you add value, you refurbish it, and then at the end of that cycle, you're looking to refinance for a higher value and ideally pull a lot of your equity or money out that you've put into that process. So let's talk about the scenario where you've bought property, you've done the refurbishment, and now you're going to refinance. Now, when it comes to property ownership, the banks, the lenders like for you to own that property for at least 6 months before refinancing. There's a whole host of reasons why, but it's mainly to do with fraud and corruption and gangs, and therefore people can no longer as easily as they used to be able to refinance on the same day as buying or 1 or 2 days after buying a property. Now they'd like for you to have at least 6 months, but that doesn't mean it's impossible. As I've said, let's take the scenario where you purchase a property, you refurbish it, and now you're looking to refinance, but maybe you've only been in this process for 3 months. You've got another 3 months to go until you can refinance. So what do? Do you stay sitting on that high interest mortgage or high interest bridging loan, or do you try and refinance early? Because there are some products out there specifically for refinancing pre 6 months. Now it's important to note that not many lenders do this. So if you are looking to refinance early before the 6 month mark, you're going to have a more select pool of lenders, and also you're more likely to slightly pay more in terms of interest rates. But it can be done, that's the important thing. Let's apply this to a recent example of myself. I bought a property earlier this year, bought it below market value, I refurbished it, and I was at the point after 4 months in which I wanted to refinance that money out. Now the question is, do you wait for 2 months and you pay a higher interest mortgage rate or bridging loan, or do you refinance early? Now, if you refinance early, the bank are going to be looking at a couple of different things. That is your purchase price and the amount of money that you've spent on the property, and they'll look at like a schedule of works, all of the different materials you've bought, and they'll really look to see whether, well, if you bought this property for 70,000 and you want it to be worth 130,000, have you spent enough money on it to justify that? And does the market stack up to prove that this property is worth 130,000? Whereas if you waited till after the 6 month mark, well, really the bank are just coming in fresh and they're saying, is this property worth 130,000? Let's look at the properties in the local area, the local streets, to see if the sold prices stack up and match that. So to round this part off, in answer to your question, I did actually go for a slightly early refinance because I wanted to get the wheels in motion. And now that we know that the refinance process can take 4 to 6 weeks, well, I wanted to kickstart that rather than waiting until after 6 months, then starting it and then adding that additional time on. So now let's take this a step further. Let's look at some figures to try and put that into context a bit more. And I'm going to mention a couple of really important things to note. So the first thing being that when we do a refinance, if we're looking to leave 25% in as a deposit and refinance out a new 75% mortgage, well, we're going to have to leave in a new higher 25% deposit. What I mean by this is if you purchased the property for £70,000, your deposit would have been £17,500 versus the new value of £130,000, well, you're going to have to leave in £32,500. Meaning that you need to push the end value up to a certain level that you want to achieve, but also factor in that you're going to have to push the value up enough to factor in the refurb costs and all the costs, as well as leaving in a higher deposit amount. So when you go out and view a property, what is the easiest way to calculate this? Well, I've covered this in a previous video. What you want to be looking at is what is the end value, what is 75% of the end value, because that's the new mortgage on it, and then you're going to deduct the refurb costs, the stamp duty and solicitor fees, and then you're going to be left with the amount of money that you can offer on that property. So in short, my first tip is to remember that you're going to have to leave in a higher deposit when you do the refinance. Now, my tip number 2 is interest only versus repayment. Now, this is your opportunity to decide whether you want to do interest only versus repayment. Now, this is a whole topic of its own. In fact, I've made a whole separate video on it. If you want to view that video, click the link above in this video. But a lot of people think, and this is a bit of a misconception in the property space, a lot of people think that when you purchase a property and you decide on interest only or repayment mortgages, that you have to stick with that decision for the entirety of your investment journey. That's incorrect. You can mix and match properties. You could have a couple on interest only, you could have a couple on repayment mortgages, and you can also switch that during the process of owning a property. So if you buy one house, you have it on a 2-year interest only mortgage, you can decide to switch over to repayment when you come to refinancing. So this is the perfect opportunity to remember that you can switch if you wanted to, and in fact that you don't have to stick to one or the other. In my personal decision, I'm looking to build a portfolio off of interest only mortgages for the first 5-10 years, and then as time goes on, I've built up a bit more of a portfolio. I'm going to start switching a percentage of my portfolio over to repayment in order to pay down some of that debt. Now, a couple of things to end on here is that, first of all, I would really wanted to emphasize that I would work with a broker. I find it incredibly useful and saves me a lot of time when I can have 1 or 2 half-an-hour conversations and then someone is comparing the whole of the market for me and finding the best possible rate for me. And number 2, what I wanted to say is that you should really start this process early. If you are coming up for a refinance in March next year, then you should be looking to start that process 2 or 3 months early, knowing that this process probably takes you the best part of 2 months. Don't leave it until the last minute, otherwise you're going to get to the end of your previous product. You're then going to have to start paying the higher interest rates. And last of all, don't forget to play the long game. At the end of the day, we're in this for 10, 20, 30 years. We're building wealth for ourselves. So let's remember not to pull out too much equity and over leverage debt. And equally, when we have an opportunity, don't leave too much of your own equity in a deal when you can leverage debt. You could pull out more money and then put that down as deposits on future properties. So hope you enjoyed this video. Don't forget to like and subscribe, and I'll see you next week.